No, what do you know? More rule changes from the government. Are they going to be good or bad? Well, I'm going to dive into it and share with you my thoughts and my analysis of what these changes will do. If you haven't heard, OSFI, or the Office of Superintendent of Financial Institutions, who regulates all of the federal A lenders, so that's your banks and monoline lenders. The only ones exempt are credit unions, which are provincially regulated. But they've been told there's going to be a new guideline kicking in January 1st, and it is going to require that 75% of the lenders' lending portfolios have a loan to income ratio of 4.5 or less. So this means if you make $100,000, you need to be borrowing on your mortgage $450,000 or less. If you borrow more than $450,000, you fit into a special category, which would be that kind of 25% of non-conforming loans. Now, I have some concerns about this. I think that the impact is going to be a little bit broader than we expect. At surface level, it looks like a non-change, and that's what my initial thought was. But as I actually started to crunch the math, I realized that, this could have a very substantial impact on Canadian borrowers, and I want to share with you why. So first thing we need to dive into is kind of what's going on with interest rates, because this sets the backstory of what we're dealing with. So over the last 6 months, we've heard lots of news about the Bank of Canada has not cut interest rates. But what they don't typically talk about is that the Bank of Canada controls variable interest rates. Fixed rates, and in this case, this is 5-year bond yields, which are going to influence 3 to 5-year fixed rates typically. Over the last 6 months, they've plummeted almost 0.6, 0.7%. So Canadians are getting lower interest rates on 3 to 5-year fixed rates than they did 6 months ago. Now, the kind of bad news short term for anyone who's thinking of getting a mortgage sooner than later is that they've been trending back up a little bit on inflation and economy concerns, particularly being led by the US. But at the end of the day, bad news for the economy and dropping inflation and lots of unemployment means rates go down. If the economy is strong and inflation's stable and employment is stable, then rates are likely to stay where they're at or trend up a little bit. The long story short, it's been relatively stable since January 1st. With a little bit of a trend up. So we may see rates start to trick up. But long term or big picture over the last year, you'll see that rates have gone up relatively substantially. They've fallen off, risen a little bit, and big picture stabilized. Now, why does this matter? Well, with these loan to income requirements, what I did was I graphed out the impact of the changes before and after. So this looks at the 75% of lending that lenders need to do, or the banks need to do, to fit within this 4.5 times ratio. So on a 25-year mortgage, there's no change if you borrow at 6.5%, 6%, and 5.5%. But the moment you hit a 5% rate or lower, we start to see a change. Now that change is going to range at about 5%. It's about a $10,000 difference on a 25-year mortgage. And at 3% rates, we start to hit what's called the benchmark rate. So that's the minimum rate they'll qualify you at, which is 5.25%. At that level, it's a $92,000 difference. That's what this gap is. If the banks conform or fit you within that 75% that have to be 4.5 times or less, you're going to qualify for $92,000 less than you would if this 4.5 times loan to income requirement wasn't there. Now, I wish to say that this is as bad as it gets, but it gets even bigger. On a 30-year amortization, the differences start to kick in at about 5.5%, and they get all the way up to this gap for a 3% or lower rate would be $140,000. Now, this is using kind of the traditional debt servicing limits that lenders have. I did a final set of graphs for you. Now, this is if a lender gives you extended ratios. In the land of extended ratios, we start to hit differences essentially immediately. Even if rates don't drop, this will start to impact borrowers. And if we get all the way up to that 3.5 or 3% rates, we're going to see a $244,000 impact on the qualifying power. And all of these examples are for someone earning $100,000 a year. So I think that there is a possibility that if we do see rates drop, this is going to have a quite profound impact on what Canadians can qualify for. There's some considerations we have to weigh, like how they're going to look at new business versus old business. It's possible that as borrowers pay down their mortgages over time due to the amortization or paying off the loan, it's possible that we will see it balance itself out. But my concern is that if lenders don't balance their business correctly, or if we see a surge of buyers, let's say because rates drop, we're going to see lenders forced to choose between one person gets to qualify for more because they fit in the non-conforming or the allowed to go beyond 4.5 times income, and 3 borrowers to fill up the other 75% can't. So I want to ask you, do you think this is fair? Is this a good change? Is this a bad change? Is the government overstepping, or are they protecting Canadians? What are your thoughts on the Canadian government, or OSFI, adding in new requirements to the banks? Like, if we all look back and we talk about the stress test, it was probably a good call. The problem is there already is a stress test, which is the rate you get plus 2% is what you have to qualify for payments. And they can only use a certain percentage of your income. It's called TDS or GDS, total debt service or gross debt service. I won't get into what those ratios are. Comment if you're curious, I'll give you the answers. But at the end of the day, the banks already have to follow the stress test and limits on their debt servicing ratios. As interest rates drop, there's a minimum qualifying rate called the benchmark rate, which is currently 5.25%. So if you qualify it, if you get a rate of 3.25 or less, it does not matter. Your qualifying power stops going up, and you're capped at qualifying as if you got a 5.25% rate for the stress test. Now, they've made it so that as this drops, this new requirement's going to kick in, and we can see that it's going to kick in somewhere between 6 and 5%. We're already there. Currently on rental properties, people are getting interest rates around 6 to 5.5%. On owner-occupied properties, we're seeing people get 5.5 to 5%. And then if you're putting less than 20% down to live in a property, we're seeing rates in the kind of high fours. So what is this going to do to the market? I'm genuinely curious your thoughts. I'm going to think on this a little more, because my initial impression was these changes weren't a big deal. And then as I dove into this, I don't know if they're going to have a profound impact depending on how it's calculated, but I'm starting to see the possibility it will. So share with me, how do you think this is going to impact yourself, your clients, your community? Let's talk about it, because really I think that's all we can do. And if we talk, we can find solutions, we can have a better understanding, and hopefully we can create some change in the Canadian housing market, because it sucks. It's just nuts. I'll make another video another day about it, but multiple offers and people struggling to buy, unable to afford rent because rents keep going up. It's not fair. I don't like it. I want to see prices come down. I want to see more housing inventory. I'd love to see lower rents, but I'll do that video another day. For now, this is on the new rules, the 4.5 to 1 loan to income requirements. So we'll chat soon.